Options trading can appear complex at first glance, but its underlying principles are straightforward. At its core, options trading is about making strategic decisions based on market predictions. It involves understanding the potential future movements of an asset's price and leveraging that knowledge to make informed trades. While the terminology and mechanics might seem daunting initially, breaking them down into simpler concepts can make the process much more approachable. In essence, options contracts provide the holder the right, but not the obligation, to buy or sell a specific asset at a predetermined price, known as the strike price, before a certain date, the expiration date. This flexibility is what makes options so appealing to many traders. They offer a way to potentially profit from market movements without the need to own the underlying asset outright. This can be particularly useful in volatile markets where prices can swing dramatically in short periods. There are two primary types of options, calls and puts. Each serves a different purpose and can be used in various strategies depending on the trader's outlook and goals. Understanding the distinction between these two types is fundamental to mastering options trading. Call options grant the right to buy the underlying asset, while put options grant the right to sell. This basic difference is crucial because it determines how traders can position themselves in the market. For instance, if a trader believes that a stock's price will rise, they might purchase a call option to benefit from that increase. Conversely, if they anticipate a decline, they might buy a put option to profit from the drop. Traders purchase options anticipating the underlying asset's price will move in a favorable direction, allowing them to profit from the difference between the option's price and the asset's price at exercise or sale. This potential for profit is what drives many to explore options trading. However, it's important to note that this potential comes with its own set of risks and challenges. Options trading offers a flexible approach to participating in the financial markets, allowing traders to speculate on price movements or hedge existing positions. This versatility makes options a valuable tool for both individual investors and large financial institutions. By using options, traders can tailor their strategies to match their risk tolerance and market outlook, whether they are looking to capitalize on short-term price swings or protect long-term investments. However, it's crucial to remember that options involve risk, and a thorough understanding of their mechanics is essential before engaging in any trades. Without proper knowledge and preparation, traders can face significant losses. Therefore, education and practice are key components of successful options trading. Many traders spend years honing their skills and developing strategies that work for them. Options can be powerful tools when used correctly, but they require careful consideration and a well-defined strategy to navigate the inherent risks and capitalize on potential rewards. By taking the time to learn and understand the intricacies of options trading, traders can position themselves to make informed decisions and potentially achieve their financial goals. Whether you're a novice or an experienced trader, the key to success in options trading lies in continuous learning and strategic planning. The covered short strangle is an options trading strategy that involves simultaneously selling or writing an out-of-the-money call option and an out-of-the-money put option with the same expiration date. This means that the strike prices for both the call and put options are set at levels that are not currently achievable by the stock price, making them out of the money. Additionally, the trader must own 100 shares of the underlying stock to execute this strategy. Owning these shares is crucial because it provides a safety net against potential losses from the short call option. This strategy is considered covered because the trader owns the underlying shares, mitigating potential losses on the short call option. Essentially, the ownership of the stock acts as a form of insurance, ensuring that the trader can deliver the shares if the call option is exercised. The term strangle refers to selling both a call and put option with strike prices further away from the current stock price than a traditional straddle. Unlike a straddle where the strike prices are the same, a strangle has different strike prices for the call and put options, creating a wider range for potential profit. This strategy aims to profit from time decay, also known as theta, as the value of options erodes as they approach their expiration date. Time decay works in favor of the trader because the options lose value over time, allowing the trader to potentially buy them back at a lower price or let them expire worthless. The covered short strangle is best suited for traders who have a neutral to bullish outlook on the underlying stock and are comfortable with the risks associated with short options positions. This means that the trader expects the stock price to remain relatively stable or increase slightly, but not to experience significant volatility. The strategy generates income upfront from the premiums received when selling the options. These premiums provide an immediate cash inflow, which can be attractive for traders looking to generate additional income from their stock holdings. However, it also carries the risk of potential losses if the stock price moves significantly in either direction. If the stock price rises sharply, the trader may have to sell their shares at the strike price of the call option, potentially missing out on further gains. Conversely, if the stock price falls significantly, the trader may be forced to buy additional shares at the strike price of the put option, leading to potential losses. Therefore, it's essential for traders to carefully assess their risk tolerance and market outlook before implementing the covered short strangle strategy. Proper risk management and a thorough understanding of options trading are crucial to successfully executing this strategy and achieving the desired outcomes. The covered short strangle strategy is primarily employed for its income-generating potential. By simultaneously selling both a call and a put option, the trader receives a premium upfront. This premium represents the maximum potential profit for the trade. The income generated from this strategy is attractive to investors seeking to enhance portfolio returns or generate cash flow from their holdings. As the options approach their expiration date, the time value of the options decays, further benefiting the trader. However, it's essential to remember that income generation should not be the sole consideration when implementing this strategy. The potential for unlimited risk must be carefully weighed against the income potential before entering the trade. While the covered short strangle can provide attractive income opportunities, it's crucial to implement it within a well-defined risk management framework. Risks and rewards, a balancing act. Like all investment strategies, the covered short strangle involves a balance of risks and rewards. This strategy, while potentially lucrative, requires a deep understanding of market movements and a keen eye on the underlying stock. Investors must be vigilant, constantly monitoring their positions to avoid unexpected losses. Understanding these aspects is crucial for making informed trading decisions. Without a solid grasp of the mechanics involved, traders might find themselves in precarious situations. It's not just about knowing the potential profits, but also being acutely aware of the risks that come with it. Risks. The most significant risk associated with this strategy is the potential for unlimited losses on the short call option if the stock price rises sharply. This can be particularly dangerous in volatile markets, where stock prices can swing dramatically in a short period. While owning the underlying shares mitigates some of this risk, it doesn't eliminate it entirely. The stock price could still rise beyond the strike price of the short call, leading to substantial losses. Therefore, it's essential to have a risk management plan in place. The maximum profit is capped at the premiums received when selling the options. This means that no matter how favorable the market conditions are, the profit potential is limited. Traders need to be comfortable with this cap and understand that the strategy won't yield unlimited gains. This limit exists regardless of how much the underlying stock price moves in a favorable direction. Even if the stock price skyrockets, the profit remains confined to the premiums collected. This can be a point of frustration for some traders who might feel they are missing out on larger gains. Rewards. As mentioned earlier, the primary allure of this strategy is the upfront premium received from selling the options. This immediate income can be particularly attractive for traders looking to generate cash flow from their investments. This income can boost overall portfolio returns. By consistently collecting premiums, traders can enhance their returns over time, even if the stock price doesn't move significantly. This steady stream of income can be a valuable addition to any investment portfolio. The strategy benefits from the natural erosion of options value as they approach expiration, known as theta decay. This decay works in favor of the option seller, as the value of the options decreases over time, leading to potential profits. This decay accelerates as the expiration date nears. Traders can take advantage of this by timing their trades to maximize the benefits of theta decay, ensuring they capture the most value from the options sold. Traders must carefully weigh these risks and rewards, ensuring they are comfortable with the potential for unlimited losses before implementing this strategy. It's a delicate balancing act that requires constant vigilance, a thorough understanding of market dynamics, and a well-thought-out risk management plan. Only then can traders hope to navigate the complexities of the covered short strangle strategy successfully. Bullish trends: the ideal scenario. The covered short strangle strategy thrives in environments where the underlying stock exhibits a neutral to bullish trend. This is because the strategy benefits from range-bound price action. When the stock price trades within a relatively tight range, the options are more likely to expire worthless, allowing the trader to keep the entire premium received. A gradual upward trend in the stock price can be beneficial, as it increases the likelihood of the short put option expiring worthless, while potentially allowing the trader to profit from the long stock position. However, it's important to note that this strategy is not suitable for highly volatile stocks or during periods of significant market uncertainty. In such environments, the risk of substantial losses increases significantly. Traders should carefully analyze the underlying stock's price history and current market conditions to determine if the covered short strangle aligns with their risk tolerance and market outlook. That's it for now. Thanks for watching. See you next time.